thing that we do tell employers, though, regarding the pending legislation is your workforce, your employees are dealing with this problem now. They're dealing with this issue now. They're dealing with this reality now. They're dealing with not being able to make the cash flow work in their lives right now. And so to put off doing something that your workforce needs in hopes that the government does something at some point in the future, that's an okay decision. It isn't a decision I would make, but it certainly is a valid decision. I think the rallying cry for doing something for this portion of the workforce, though, is right now, because any way you look at this issue, the 44 million people who have student loan debt are really suffering under that burden. And it does have an effect on their relationship with their employers, and that's what this benefit is ultimately meant to solve.
Well, with Student Loan Genius, so the benefit is not just the contributions, right?
Wait, is this with the advertising stats?
No, well, the real issue that a lot of people don't realize is that people are coming out with a very complex situation when they leave school with debt, right? So on average, like our users they have 12 loans that are paying 2 or 3 different servicers. And so when they think about consolidation, refinancing, or income-based programs, all these different terms they've heard, they don't know who to call. Like, do I call Sallie Mae or do I call Navient, right? Are they gonna give me the right information or not? So our tool is developed to help them first get peace of mind that they made the right decision on what's best for their student loan situation, and then like getting the company contribution on top is like icing on the cake.
How much of your platforms, how helpful are they in deciding what student loan repayment should I choose, and really even understanding and being educated on how much is this going to cost me over the long term?
You know, we both agree on this because I just heard there's a lot of education that's needed on the front end to help the individuals who have this debt. You know, the terminology involved is unusual. Even the statements that you get from your servicer don't look like anything else that you've gotten from anybody else. Yeah. And then some of the, quote, benefits that you can take advantage of have implications that you might not understand. Or if you do understand, you don't understand them thoroughly. And there is a part of this that I think is even a bit unfair, and that is when this all starts, you're talking about a young person who's generally 19 years old, who's signing documents that look like this, and I hesitate to even imagine how many of them have read it, never mind understand what they're signing up for. And our ability, your company, our company, to help that individual just sort out what their circumstances are, what their alternatives are, where they should act, and by the way, in some cases, where they shouldn't act, where to go for more insight about certain of the programs that are available to them, repayment options, et cetera. I know we feel very strongly that the more education we provide, the better the decision-making of the individuals involved.
Yeah, so for our benefit, a company actually doesn't have to do the contributions, right? So if they're not ready, they're not sure how much to budget, how many employees have student loan debt, they can offer our advising tool that essentially helps an employee figure out what's the best thing I should do with my loans. And when we have users go through that process, about 2/3 actually make a change. So they're typically going into income-based programs. That's what most of them do. Less than 10% of our users decide to do refinancing, or actually even qualify for refi, and about half of them choose to actually go into refinancing because people just really want to lower their monthly payment. And so for most of our users, 2/3 are choosing to go into an income-based program, and they're saving about $251 on average per month. That's a huge amount of money. That's over $3,000 that a user now has, or an employee now has, that they can put towards savings, they can put towards 529, they can pay off debt, whatever the issue is. But it's a significant amount of money, and people have access to these free programs, but they've never essentially been guided through the process, right? So now having the ability to put that in front of them is really critical. The second piece, though, is with our benefit, we allow family members to use it. So if an employee doesn't have student loan debt, but they have a kid who does, and maybe be going through the school, they can allow that kid or that student to use the tool to figure out what their student loan situation is before they even get their first job.
How would you assess, for those of us who I haven't been paying off loans recently, how would you assess the system right now that the federal government and their loan servicers have in place? Wow. I've seen it. It's messy.
That's a tough question, Katie.
That's a really tough question.
And do we need people in the private sector to move this along and make improvements for consumers?
Want me to
Yeah,
take
you
first
can
stab?
step on it
Okay.
first. Yeah.
So the reason I started Student Loan Genius was I knew the government couldn't solve this problem. Like the problem was way too big. And there's nothing they could do. The way they're solving it now is like new income-based programs, which are essentially pushing out the loans for as long as possible and letting people, increase the amount of interest that they're paying. And it was a terrible situation. And so with our benefits, now we can get the private sector involved to actually help solve the problem. And so I think the government has done as much as they can do. They shouldn't try to do any more. Now that we actually have the private sector excited about it, it's great that companies are helping with the problem. But with Chipper, what we're building now is a rewards platform too, where brands can now get involved, right? So it's not just employers. Like we want the entire private sector to get involved and start helping solve this problem.
Yeah, I would say, part of this for me is a little bit, here in New York, I can do deja vu all over again and feel good about it, even being a Red Sox fan. So it reminds me a lot of the consumer credit card space not that long ago, where what happens amongst the participants in the industry is not where you want it to be from a pro-consumer perspective. And I think it's a little vague, it's a little opaque, the rules aren't really understood, who makes the rules, who enforces the rules, what information you give the consumer, when you give it to them, is it always on, pro-consumer in terms of the advice you're giving and what step to take? As I said a few minutes ago, even the statementing, looks a little odd to me because things that you would and have seen on your credit card statements for years that tell you exactly where you are with that debt don't exist in this space. And I think, and I hope this turns out to be the case, I think there's going to be kind of rapid adoption of pro-consumer policies, and it will eventually look a lot more like other financial services that we have in this country, which is well lit, well understood, and all the participants will have to play by a minimum set of standards that involve pro-consumer treatment.
But what makes no sense to me was that with the last administration, there was this effort to combine all the student loan servicers into one major platform. So there was no confusion, like there was a certain process of how like people would, if they wanted to consolidate or like figure out their options, they would call one person. And with this administration like that last week, they're like, we're not gonna do this, which makes no sense. Like I don't understand like why they're refusing to like put this program in place because it's better for all consumers, right? The default rates would decrease, delinquency rates would decrease. People would be able to take advantage of these programs that they put in place, and to just say that let's keep things as is like makes no sense to me at all.
Before we move on from that point, I think the argument is what about competition? If you give all the power to one company, aren't you worried that there's no competition or checks and balances there?
I mean, but most of them are nonprofits. Like they're not true companies, right?
Yes.
Like they were picked by the federal government to say like service our student loans.
There are 9 companies and organizations that currently have contracts with the federal government to service the loans.
So it makes no sense. Yeah, of course there's but I don't know what's happening behind the scenes. Like I'm sure we can assume what's going on, but yeah, like the government picked these companies to say service these student loans, and to say like, hey, we don't want to give our Americans who are college educated a better service to figure out what's best for their student loan debt and put more money in their pocket, like it makes no sense at all.
So to what extent does Student Loan Genius and Tuition.io have to work with those loan servicers exchanging information in order to make this work?
We do, and we do heavily. So the platform that we have is electronically integrated into all the servicers for all different types of debt, be it federal or private or parent or whatever it is. We connect to the servicers, to the debt providers on the back end for all those loan types. We need that based on how our platform operates. So it's a continuous aggregation model that we've built off of our platform so that we have that full visibility to the consumers' back-end loans, back-end loan balances, back-end payment history, and all of that. And we find that key element of our platform is what differentiates us in the market by comparison to everybody else. It is hard work. There's a lot of technology. There's clearly a lot of things that could go wrong at any moment in time, but that is the centerpiece of what our platform does.
And we're on the opposite spectrum where we focus more on integrating with the fintech like platforms that exist, because we weren't sure what was going to happen with these servicers, right? I knew like there was the negotiations happening about, you know, are we going to provide like one new service, or like what's going to happen with, you know, who we're making student loan payments to. So our approach was, let's work with the Department of Education to get the student loan data first, and then from there we plug into, you know, modern fintech, you know, APIs and technologies to make the payments. So we don't work directly with the servicers.
So Tony, you said that a lot of your users end up going into a different repayment program and lowering their monthly payments, which is great if that's, you know, if they are struggling and they don't have a big salary yet. Do we know yet, do we have the data on people who use your platforms and get this benefit? Are they able to pay off their loan faster? Is it maybe encouraging them to put more into make their loan payments bigger and do it faster?
So what's been interesting is that users don't realize the effect of compounding interest, right? And so within our tool, you know, once they optimize their loans and find this new repayment program, we give them the option to, you know, what does an extra $20 or $30 or $40 per month actually like do to my situation? And in most cases, it saves thousands and thousands of dollars and years on repayment. And so what we've seen is about 20% of our users actually choose to pay more than what their minimum payment is. So it's great. It's just giving visibility, right? Giving them the access to actually see what this extra $20 can do. And most people can afford an extra $20 student loan payment, you know, and save, you know, $4,000 over time. So, you know, it's hard to say that yes, people are paying off their loans faster by using our platform. For sure, if they're getting a contribution from the company, but again, most people are choosing to lower their monthly payment and just stretching out their term.
Yeah. So again, we're a little bit different, and one of the things that we offer to the employer when we're doing plan design around contributions is to stipulate to their employees that they need to make the primary payment every month, and as a result of making that primary payment, then you're eligible for the employer payment, the employer contribution. So in order to fulfill that plan design, we of course have to have the integration that I was talking about before. We have to have the visibility to the loan accounts on the back end. We have to be able to see those payments. As a result, we get to see before and after behavior, and it's very interesting. We don't have a point of view on how you should design your plan as an employer, but what we do see when the employers say, we don't want to make the primary payment, we want our employee to have that responsibility. When they make it, then they'll be eligible for the, you know, the contribution payment. We see a dramatically higher currency of the loans on the back end, meaning the consumers involved, the employees involved understand they have that responsibility, and much higher frequency, they keep their loans current. I think that's great behavior, and then we can begin to model for the employee and the employer how much time you're going to save, how much interest you're going to save, and ultimately what the effect of the benefit is. And that's where this gets very exciting, because we can show you what that collapsing term is and the collapsing total interest you're going to pay over the life of your loans as a result of this benefit. So we make that available because of the integration and the plan design that I was talking about.
What's interesting too is that there's like certain companies that we work with, about 10 to 15% of their employees may be like in delinquency or default. So they're like, they have good jobs and they're making good money, but they're not paying their student loans. And
Do they realize they're in delinquency?
Oh, they realize it, but they're, you know, and then we have, you know, a customer success team that can walk through the process of like, hey, here's my situation, what should I be doing? Like, is it too late for me to like get into one of these income-based programs? And it's not. They just have to fill out a piece of paper. Like, and it's an easy process, but they've never been exposed to the process before. So it's interesting that, you know, you have college-educated people who make good money, but are still choosing not to pay their student loan debt.
So I'll ask one more question before we open it up to the audience, but I did want to ask about getting these private companies, whether they're their employers or if you're looking for a company to offer rewards for a chipper. How do you, when you talk to them, what are their hesitations and how do you get them on board?
The employer's hesitations?
Yeah, why would an employer be like, I don't want to sign up for this right now, or what are the reasons for that?
Yeah. So First thing I would say is, it is almost certain when you walk into an employer, any industry, any size, that they will have some issue with their workforce that involves student loan debt that they want to talk to you about. Generally, it's retention, and generally the problems are significant. So it is not unusual for us to walk into a large employer and have them say, of the college graduates we hired in the last 12 months, 40% of them are gone less than 12 months later. Think about that for a second. I mean, the ROI on, the talent acquisition of that company is upside down, right? And I could go story after story after story. So they see it. They clearly see it. The second thing that we generally talk about is, okay, I like the benefit. I see what it might do for retention. I see that it is specific for this portion of my workforce. But that's 25 to 35% of my workforce, and my strategy around benefits is total rewards, so that when I do something, everybody benefits from it. And that's a hard conversation because, the numbers are 25 to 35% have student loan debt today, generally on average, so you can't have this benefit apply to everybody. But then you have to pass that a little bit because, the concept of total rewards makes sense. But as a for instance, if that employee who has student loan debt isn't participating in your 401k plan, then the concept isn't valid. And by the way, when you look at data with these large employers, that's what you see. A decreasing percentage of people participating in retirement plans, including 401k. Double click on that. Who are the individuals that aren't participating? It's the younger portion of your workforce because they can't afford to, for the reasons that we're talking about. So you have to go a little bit deeper, and then you have to pull it all apart. And then the final thing, we get stuck on occasionally is just the size of the benefit, because when they begin to understand what percentage of their workforce has student loan debt, almost all of them are going to enroll in the benefit in the first 30 days. That's what we see. Absolutely. It is remarkable how quickly it gets adopted. The enrollment happens in a flash. And they quickly then do, okay, if it's that many people times $100 a month times 12 months a year, oh my word, I didn't budget for that amount.
Yeah.
And so there's a pause there. And you can't argue with that because that's their budget, absolutely, not our budget. They recognize and appreciate it's the right thing to do. It will help solve a problem. But there's a conversation that needs to be had with the CFO before you can go ahead and move this forward. And by the way, if you're you or me, you can't say, well, you had this in the budget for other benefits. It just isn't being used by these individuals. No, it doesn't work that way.
Yeah, I wish it did.
I know, it'd be really easy if it did work that way. And so it really is, that's kind of the sequencing of the conversation that you go through. But then when you start to do the math on what's the ultimate ROI of this benefit against retention, talent acquisition spend and retention, you can quickly get to the point where you can afford more than $100 per employee per month, and have a positive ROI from that. I don't think that's arguable.
Well, also I think the conversation has evolved in the last 4 years with these employers, right? So when we came out with the benefit, they'd never seen this before. So they're like, who are you? Like, how big's your company? We'd be in rooms where it was just our, 3 co-founders like sitting in there, and like why should we trust you? But now that it's more common, bigger companies are using it, the conversations I think, go a little smoother than they used to.